In our video, which you can click here, we talked about the 10 greatest strategy entries, and now it's time to talk about the 10 greatest strategy exits. Every trading strategy has those two important building blocks, entries and exits. Exits are often overlooked, but they are just as important as strategy entries. Great exits can help you manage risk, they can help you lock in profits, and overall they can make you a better, more confident trader. And make sure to stick around to the end of the video because we'll be talking about the GOAT, the #1 exit for building simple, profitable, systematic trading strategies. So the 10 greatest strategy exits, let's get into it. Hi everyone, it's Dave Whitcomb, Head of Research for Peak Trading Research in Geneva, Switzerland, and my goal is to make you a more confident trader with commodity market insights and real systematic trading strategies. And today we are going through a very important and not to be overlooked part of systematic strategy building, and that is great strategy exits. As always, we'll be looking at some easy language strategy code, but focus less on the code itself and more on the strategy logic. That way, if you're using another coding language like Python or C++ or R, or you're doing your work in Microsoft Excel, you can still use these exits. So let's get started. Let's look at the greatest of all time strategy exits, starting with exit number 10. For the first exit that we'll be looking at, this is a system where your entry is the same as your exit. This is a complete trading system that is always long or short. The way this strategy works is if the market close is the highest close of the last 6 bars, then the system will buy the next bar at market, and vice versa. If the close is the lowest close of the past 6 bars, the system will sell short next bar at market. And again, it's a complete system. The system is always long or short. It's always in the market. And we can see what this looks like if we add this strategy to a heating oil 240-minute bar chart. The system does a nice job of selling short on downward momentum and buying upward momentum, selling short on downward momentum. If we look at a strategy performance report, the system has done fairly well over the past year for just 2 lines of code, always in the market. This run up here is Russia's invasion of Ukraine, when we saw a lot of volatility and a lot of big breakout moves in heating oil futures. For our next trading exit, we'll just look at a simple stop loss. This is the simplest of all exits, and it's a good way to manage risk. What this exit does is it says if the system is at any point losing $5,000 per contract, just exit the position. Exit the position immediately. And if we add this stop loss exit to our GOAT stop breakout entry that we worked on in our video on strategy entries, we can see what this looks like on a chart. Again, the strategy is going short on lower momentum. It's buying upward momentum, but we can see that once in a while it's hitting a stop loss. And this brings up an important question. Do you need a stop loss? Does your system need to have a stop loss? Not necessarily. You can build systems that are always long or short, that are always in the market, that are always waiting for that next trading signal in the opposite direction to get out of a trade. A stop loss will generally help you sleep better at night. It's just a nice way to know that if things really go wrong, you're going to get out of a position. So bottom line, even if adding a stop loss maybe doesn't improve the backward looking equity curve of your trading system, you should still consider adding a stop loss. It's good, simple risk management, and it makes your trading system more realistic, more tradable. For our next trading exit, we have a simple profit target, like a stop loss. This is a simple line of code that will take profit on a position if the total gain is more than $10,000. And if we add our profit target to our G.O.A.T entry and add it to a heating oil 240-minute bar chart, we can see how a profit target works. The system will sell short, hits a profit target, go short again, hit another profit target, and so on. Now you might ask, why add a profit target to a trading system? Why not just let your winners always run? There are two reasons for this. The first reason is if you look at an equity curve going back through time, you'll often find 1 or 2 or 3 really big gains that make up most of the profits over the course of the past 10 years. Meaning the trading system happened to catch a few big volatile moves like the financial crisis or the COVID washout or Russia invading Ukraine, and you don't necessarily want to rely on a system that plays for those types of events in the future that you may not catch. And adding a profit target limits the impact of those one-off macro events. The second reason is adding a profit target just makes your system more realistic. If your system usually makes gains of $1,000 or $2,000 or $3,000 per contract, and all of a sudden you find yourself sitting on a gain of $5,000 or $6,000 or $7,000 per contract, realistically, you will probably take profit on that position. We all want to say that we're systematic traders and that we'll always let our systems run, but realistically, if you're sitting on a big gain, you'll probably take those chips off the table. Why not code that in? Why not code in a profit target? Our next trading exit is a simple profit target that executes on the next bar at market. There's nothing really groundbreaking here. The only difference is that if your max position profit is greater than your profit target, $4,000 per contract, $5,000 per contract, $6,000 per contract, the system will then exit at the next bar at market. It'll either sell or buy to cover on the next market bar. An advantage of this approach is that you can take advantage of the liquidity on the next market open if you're a larger trader, or if you just want to execute trades once a day. If you've built your system to always execute next bar at market, you can use an entry that enters next bar at market with this exit that always executes next bar at market. Our next exit is a simple trailing take profit exit. This is a great exit. What this code is doing is it's saying if the max position profit, so the most money that we've ever made on a position, minus the open position profit, so the current profit that we have at this minute, is greater than $2,000. So if you've made $10,000 at some point and all of a sudden you're down to only $7,500, that's greater than $2,000. This system will begin to exit. It will sell next bar at market, or it will buy to cover next bar at market. And if we combine this with our G.O.A.T breakout entry, we can see what this looks like on a heating oil 240-minute bar chart. The system went long on upward momentum and then starts to lose some money, so gets out of the position. The spread between the most money the system has made and the current money that the system has made is greater than that threshold, so the system exits. Our next exit is a protect profit ratio. This is a similar idea to our trailing stop, but it's phrased a little bit differently here. If the max position profit is greater than a threshold of $5,000 per contract, the system is long, and the open position profit over the max position profit is less than 0.5. So if you've given back 50% of your gains, then get out of a position, vice versa if the market position is short. If we add this to a heating oil 240-minute bar chart, again, we can see how this works. The system went short here on lower momentum, was making good money. Then the system got above that profit threshold. The market started to revert higher and the system gets out. Same thing happened here. System went short, market starts to revert higher, and this system gets out because of this exit. All right, our next exit is a quick spike profit exit. What this exit does is it says if your market position is greater than 0, if you are long, you're selling the next bar at the close plus 3%, and if your market position is less than 0, if you're short, you are buying to cover at the next bar minus 3%. And if we look at what this exit looks like on a chart, we can see that when you have a big move quickly in your favor, so if you're short and the market spikes lower, or you're long and the market spikes quickly higher, you are going to exit immediately. Our next exit is an ATR Stop. What this code does is it says if you are long and the market starts moving against your position lower, as defined by this average true range over the past 10 bars times 2, you want to stop out of your position. Vice versa, if you're short, you want to buy to cover if the market starts moving higher by this ATR times 2 value. So effectively, if you're long and the market starts dropping, you hop out. If you're short and the market starts rising, you also hop out of your position. And if we add this to a heating oil 240-minute bar chart, we can see how this works. Here you've established a short position, the market starts moving higher, you stop out, you get into a short position again when momentum starts breaking lower, it's a successful trade. Same thing here, you get short, it's a successful trade. Same thing here, short, successful trade. Now you're short and the market starts moving against you, so you stop out. It's a nice way to avoid getting short into an overly uptrending market. 2 more exits to go. This is our reverse exit, reverse after X bars. So if the bars since entry is greater than 10, if you've been in for 10 bars and you are long, then you want to go short the next bar on the open. And if the bars since entry is greater than 10 and you are short, then you want to buy the next bar on the open. Effectively, after 10 bars, you want to switch directions. Now, this approach will generally work well on more mean reverting markets, a market like cocoa or coffee or nat gas, a market that you already know tends to trade in a sideways pattern. This generally will not work too well in markets that continue to break out, because after a certain amount of time, you're trading against momentum for longer trends. So what this looks like on a chart, we can see here we're buying upward momentum via our G.O.A.T entry, our G.O.A.T breakout entry. After 10 bars, we're then getting short. Here we are getting short again, and then after 10 bars, we are getting long. You can see it kind of trades in these up, down patterns, reversing the position every 10 bars. Now it's time. I know you're as excited as I am. Let's look at the G.O.A.T, the greatest of all time trading exit. And there it is, exit number 1, exit after a certain number of bars. This is a time-based exit. Effectively, if your bars since entry is greater or equal to 20, so if you've been in for 20 bars, just get out. If you're long, you sell next bar at market. If you're short, you buy to cover next bar at market. In fact, we can even clean this up a bit and make this one simple line of code. Now, if we add our G.O.A.T stop breakout entry, as always, we can see what this looks like on a chart. No surprise, our G.O.A.T entry gets us long on momentum. We get out after 20 bars. Again, our G.O.A.T entry gets us long on upward momentum, and we are going to get out after 20 bars. So when there's no other signal, the system will always exit after a certain amount of time, in this case 20 240-minute bars. Now, this might be a controversial pick for the greatest of all time exit. Maybe you like that trailing stop because it helps lock in profits. Maybe you like that reverse exit because if you think a trend is over, why not reverse and take the other direction? But believe me, you will find yourself using this bar since entry exit all the time. It's simple, it's easy to test, and trends only last so long. It makes sense to strongly consider using a time-based exit. And keep in mind, you can layer on different exits. It's very common to see a strategy have 2 or 3 or 4 different exits. You can have a stop loss, a take profit, a trailing stop, and a bar since entry exit all in the same strategy. So you now have 10 great exits in addition to your 10 great strategy entries. You can build, analyze, test, and trade thousands of different systematic strategies. So let me know in the comments below, do you like these exits? Would you use these exits? Is there anything you would do to improve these exits? And as always, hit the like button, hit the subscribe button for more great stuff from Peak Trading Research. Good luck building your strategies, and we'll see you soon.